On January 29th, the World Gold Council released a single set of numbers that quietly rewrites the map of global money. In 1 year, total gold demand reaches 5,002.3 tons, and the value of that demand hits an unprecedented $555 billion US. This is not a headline about jewelry or a retail fear trade or a short-term price target. It is a headline about reserves, sanctions, and a hidden shift in what institutions choose to trust when the dollar regime starts to weaken in real time. World Gold Council just revealed $555 billion US gold buying, and the hidden reserve shift threatens cash and long bonds. And if you save in cash, hold long-duration bonds, or depend on a retirement account, this changes everything. What if everything you believed about gold was wrong? The hook is simple. Gold demand breaks 5,000 tons for the first time, and the story is who is buying and why. In 2025, global gold ETFs add 801.2 tons, the second strongest year on record, and investment demand surges to 2,175.3 tons. Those are the numbers of a structural bid, the kind that shows up when the rules of settlement and the rules of safety are being rewritten. To understand what this means for your cash and your long bonds, you need a framework that repeats across empires and currencies. This unfolds in 4 stages, and the sequence is older than modern central banking. Stage 1 is liquidity expansion. Credit is abundant, policy is accommodative, and the discount rate is suppressed, so asset prices rise faster than wages. Stage 2 is narrative concentration. Capital crowds into symbols, dominant equities, dominant bonds, dominant currencies, and the story becomes, there is no alternative. Stage 3 is reserve reassessment. Institutions stop asking, what pays the most, and start asking, what cannot be frozen, gated, or politically impaired. Stage 4 is asset repricing. The monetary premium migrates, duration gets punished, and what looked like a safe store of value gets re-rated, slowly at first, then all at once. Throughout the last 100 years, every major monetary order follows the same sequence. This isn't prediction, this is pattern recognition from a century of data. Now, the question is not whether gold is going to the moon. The question is why the world's most powerful balance sheets are treating gold like a monetary asset again. Start with an era when money was still legally tethered to metal, and the tether snapped under pressure. In 1933, in the depths of the Great Depression, the U.S. moved to consolidate monetary gold into the state. In January 1934, the Gold Reserve Act revalued gold from $20.67 to $35 per ounce. That single policy move reduced the gold value of the dollar to 59% of its prior statutory value. In plain terms, the unit you used to measure savings was quietly diluted by decree. And the mechanism was not a market crash. It was a balance sheet decision made under political stress. The pattern is visible. Stage 1 had already happened. Credit contraction and emergency policy. Stage 2 followed. A narrative that stability required extraordinary measures. Then Stage 3 arrived. Reserve reassessment under existential uncertainty. Gold ownership was restricted, and monetary gold was centralized, because control over settlement becomes control over survival. And Stage 4 followed. A repricing of the dollar's definition against gold. A new official price was declared, and the hidden transfer was absorbed over years, not weeks. The lesson is not that history repeats in identical detail. The lesson is that when a state needs policy flexibility, the unit of account is adjusted, and long-duration promises become fragile. Move forward to the next rupture, the end of Bretton Woods. For decades after World War II, the dollar is presented as good as gold, fixed at $35 per ounce for official convertibility. By the 1960s, global dollars expand through aid, military spending, and capital flows. The world holds more claims on U.S. gold than the U.S. can reasonably satisfy at the official price. On August 15, 1971, the U.S. suspends convertibility of the dollar into gold. The gold window is closed, and the Bretton Woods system is effectively broken. Again, the sequence holds. Stage 1. Liquidity expansion and external dollar creation. Stage 2. Narrative concentration. Dollar assets become the global default. Stage 3. Reserve reassessment. Foreign holders test the promise because settlement risk is no longer theoretical. Stage 4. Repricing. Currencies float, inflation volatility rises, and long bonds become hostage to policy credibility. The timeline varies, but the sequence never changes. When convertibility ends, the monetary premium migrates, and a decade of safe, fixed income can become a decade of purchasing power loss. The third case study is modern, and it is the template the current cycle rhymes with most closely. In 2008, the global financial system hits a margin call on itself. Before the crisis, Federal Reserve assets are about $870 billion. By late 2009, after emergency facilities and large-scale asset purchases, the Fed's assets stand around $2.1 trillion. That is not an academic detail. That is stage 1 on a central bank balance sheet. Liquidity expansion at a scale that redefines the baseline of normal. Stage 2 follows quickly. Markets learn to anchor valuation to policy, and the narrative becomes, the backstop is permanent, the put is implied, duration is safe. Then the hidden stress arrives. Stage 3. Confidence depends on politics, and politics depends on distribution. And inflation becomes the battlefield where societies negotiate who absorbs the cost. Stage 4 appears in slow motion. The monetary premium drifts towards scarce collateral and away from long promises with fixed coupons. 3 systems, nearly a century of history. The same 4-stage cycle: liquidity expansion, narrative concentration, reserve reassessment, asset repricing. Now return to the present, because 2025 and early 2026 are not isolated headlines. They are stage 3 becoming visible. As of January 29, 2026, the World Gold Council states that total gold demand in 2025 hits 5,002.3 tons. The council also records the unprecedented value, $555 billion, up 45% year over year. The detail that matters is composition. Investment demand reaches 2,175.3 tons, up 84%, and gold ETFs and similar products swing from near flat to plus 801.2 tons in a single year. Physical accumulation also accelerates. Bar and coin demand reaches 1,374.1 tons, and the World Gold Council values that category at roughly $154 billion for the year. The geography matters. China and India record double-digit gains in bar and coin demand, and together they account for more than half of the global category. That is a structural bid. It is not one country. It is not one ideology. It is a portfolio-level decision repeated across institutions. Central banks and other institutions add 863.3 tons in 2025. That is below the 1,000-ton pace of the previous 3 years, but it remains historically elevated and geographically widespread. The World Gold Council also makes a critical methodological admission. Its estimate combines officially reported purchases with an assessment of unreported buying, because some banks manage gold outside formal reserve frameworks. That is what hidden reserve shift means. Not secret tunnels and conspiracy, but a measurable preference that becomes difficult to map precisely because the incentives to disclose are political. The gold price confirms the regime change. The World Gold Council records 53 new all-time highs in 2025, with an annual average of $3,431.05 per ounce, and a Q4 average of $4,135.02. High prices usually choke demand. Yet in Q4 2025, total demand hits 1,302.8 tons, the strongest fourth quarter on record, lifted by 174.6 tons of ETF inflows and 420.5 tons of bar and coin buying. Supply strains also become visible. Total supply reaches 5,002.3 tons, with mine production near 3,671.6 tons, and recycling at about 1,404.3 tons. A surprisingly muted response to record prices. One more detail in the World Gold Council tables shows why this is not a retail panic. Jewelry consumption falls to about 1,542.3 tons in 2025, down 18%, and jewelry fabrication drops 19% to roughly 1,638.0 tons. Yet the value of global jewelry demand still rises to a record $172 billion. Even when households step back in volume terms, gold remains a store of value in the form people actually hold. The center of gravity still shifts to investment. In 2025, investment overtakes jewelry as the dominant demand category, and that is the signature of a monetary re-rating. Here is where the hidden reserve shift begins to threaten cash and long bonds. Because gold's resurgence is not just gold up, it is duration down. Cash is not neutral when the purchasing unit is being negotiated. Cash is a claim on a central bank, and a central bank is a political institution operating inside a fiscal reality. Long bonds are even more exposed. A long bond is a promise to pay fixed dollars far into the future, and it lives or dies on two variables: inflation credibility and fiscal capacity. Bond math turns that into something brutally simple. If a long bond carries a duration near 20, a 1 percentage point rise in long yields implies roughly a 20% price hit before coupon income is counted. In a stable regime, that risk is compensated by credibility. In a shifting regime, that risk is the regime. Consider the current U.S. monetary baseline. In the Federal Reserve's H4.1 release dated January 29, 2026, Reserve Bank credit is shown at $6.540 trillion US dollars, with data as of Wednesday, January 28. The same release shows reverse repurchase agreements around $323.8 billion US dollars. That matters because it describes where excess cash is parking and how much short-term liquidity is being absorbed or released. The baseline is still historically large. A system built on trillions of central bank assets is a system where normalization is constrained by the risk of breaking something that now depends on that scale. Then look at the line almost nobody discusses. On the same Federal Reserve balance sheet, gold stock sits at about $11.041 billion. That is not a typo. The statutory price of gold used for U.S. accounting has been fixed at $42.2222 per fine troy ounce since 1973. In the market, gold trades in the thousands. In the ledger of the issuer of the world's dominant currency, gold is priced like the 1970s never ended. The contrast tells you something about regime choice. Gold has been deliberately kept outside the day-to-day mechanics of U.S. monetary policy, even as other institutions treat it as insurance against those mechanics. The United States still holds the world's largest official gold reserve, about 8,133.5 tons. That stockpile is a reminder that gold never stopped being a state asset. It stopped being openly used as a monetary constraint. Today, the constraint is political rather than metallic. It is measured in debt service, social commitments, and the tolerance of voters for austerity versus inflation. And that brings the bond market back into the center of the story. When investors begin to doubt that fiscal math can stay painless, long bonds demand a higher premium. Now layer in the geopolitical catalyst that accelerates stage 3. Sanctions have become an instrument of financial statecraft, and reserve assets have become targets. Roughly $300 billion US dollars in Russian sovereign reserves are widely estimated to be frozen by Western countries. That figure is now part of every central banker's risk model because it proves that reserves can be immobilized by policy. Once that precedent exists, safe stops meaning liquid. Safe starts meaning outside the veto of any single jurisdiction. Gold is one of the few reserve assets that can be held without a foreign counterparty. It settles without correspondent banks. It cannot be defaulted on by another sovereign. This is why the World Gold Council emphasizes diversification and safe haven motives. But the deeper logic is sanctions hedging. An asset that can't be frozen is an asset that keeps functioning when diplomacy fails. The second driver is the slow shift toward a more multipolar reserve system. The IMF's COFR data places the US dollar share of allocated reserves at 56.32% in 2025 Q3, down from 57.79% in 2025 Q1. In the IMF's own accounting, Total foreign exchange reserves reach about $13.12 trillion in the third quarter of 2025. A 1 percentage point rotation inside that pool is roughly $130 billion of demand seeking a new home. That scale is why small-looking shifts change markets. Annual mine production is measured in a few thousand tons, not in the trillions of dollars that move inside reserve portfolios. When reserve managers even whisper about diversification, the bond market hears it as a change in the marginal buyer, and the marginal buyer is what sets the price of a 30-year promise. That move is not collapse, it is drift. But drift matters when you price a 30-year bond on the assumption that reserve demand is permanent. Reserve diversification does not need to dethrone the dollar to damage long duration. It only needs to reduce the automatic bid for long-term sovereign paper at low real yields. And now the gold data shows the mirror image. Gold's share in global foreign currency holdings rises toward early 1990s levels, according to the World Gold Council's own reserve analysis. This is the structural bid competitors ignore when they obsess over price targets. Gold is being re-rated as a monetary asset, not because people are scared, but because institutions are updating the definition of unimpaired collateral. ETFs are the bridge that translates that institutional logic into market impact. In 2025, global gold ETF holdings grow by 801.2 tons, and in Q4 alone, inflows reach 174.6 tons. The United States shows how concentrated that channel can be. The World Gold Council's U.S. demand breakdown records 437 tons of ETF demand in 2025, pushing U.S. gold-backed ETF holdings to about 2,019 tons, valued around $280 billion US. This is not retail coin buying in a panic. This is the largest pools of capital choosing an allocation route that can be scaled, hedged, and rebalanced like any other institutional exposure. And this is where named institutions matter. BlackRock reports roughly $14 trillion in assets under management as of year-end 2025, and a large share of global ETF infrastructure runs through firms of that scale. When an ETF ecosystem absorbs 801 tons of gold in a single year, it proves the mechanism exists to convert narrative into flows. It also proves that gold can be accumulated without moving a single bar across a border, because custody and settlement are already industrialized. That industrialization is a double-edged sword for long bonds. If a marginal buyer can rotate into monetary insurance quickly, the term premium can reset faster than policymakers expect. Cash is not immune either, and the reason is fiscal gravity. As of January 7, 2026, U.S. gross national debt is listed at about $38.43 trillion. Debt at that scale is not automatically a crisis. Watch how the most conservative capital behaves when uncertainty rises. Berkshire Hathaway reports a record roughly $358 billion in cash and equivalents at the end of September 2025, held largely in short-dated U.S. Treasury bills. That positioning is not a bet against America. It is an admission that in a late-cycle regime, optionality is valuable and long duration is fragile. But it narrows the corridor of policy options, especially when inflation is politically sensitive and growth is uneven. In that corridor, cash becomes a quiet tax base. If inflation runs above the return on cash, the real value of liabilities is reduced, and savers pay the difference. Gold does not need to replace cash to expose this. It only needs to reassert itself as a competing store of value for institutions that once treated cash-like claims as unquestioned. If you are in your 20s or 30s, this affects you because your lifetime savings rate compounds through the unit you measure returns in. If the unit degrades, your average return can look fine, while your purchasing power quietly falls behind. If you are in your 40s or 50s, this affects you because sequence risk becomes policy risk. A decade of low real returns on cash and long bonds can compress the margin of safety right when you need it most. If you are retired, this affects you because your spending is real, not nominal. Your groceries, healthcare, and housing do not accept long duration as payment. They accept purchasing power. Some will say this time is different. They will say gold is simply reacting to price momentum, or to social media narratives, or to temporary geopolitical headlines. The data rejects that. The World Gold Council shows investment demand at 2,175.3 tons in 2025, with ETFs adding 801.2 tons, and bar and coin demand hitting 1,374.1 tons. Those are portfolio decisions, not rumors. They represent institutions paying an insurance premium against a set of risks that do not disappear with a single election or a single ceasefire. Others will say that long bonds are safe because yields are higher now. But higher yields do not immunize duration from regime change. Duration is a bet on stability, and when reserve preferences shift, stability becomes more expensive. Remember the 4 stages. Here is where the current cycle sits. Stage 1 is already behind us. The extraordinary expansion of central bank balance sheets over the last 2 decades. The Federal Reserve's current assets are measured in trillions, not billions, and that is the inherited structure of the system. Stage 2 has been visible for years. Narrative concentration. Global portfolios crowd into U.S. equities, U.S. duration, and dollar liquidity because the system rewards the default choice. Stage 3 is the pivot, and gold demand is a signal. When total gold demand reaches 5,002.3 tons, and ETFs absorb 801.2 tons, it suggests that large actors are no longer satisfied with promises alone. Stage 4 is what savers feel. It shows up as higher term premiums, more volatile inflation outcomes, and lower real returns on the assets that used to be described as risk-free. Now look ahead 12 to 24 months, not with fear, but with pattern discipline. The cycle does not tell you exact dates, it tells you what to watch. Signal 1 is persistence of the institutional bid even at high prices. If ETF holdings remain net positive while central bank demand holds near the 850-ton range, the market is being driven by allocation, not by bargain hunting. Signal 2 is the spread between short rates and long rates. If the long end rises while policy rates fall, it suggests the market is charging for inflation risk and fiscal risk, not just forecasting growth. Signal 3 is settlement politics. If sanctions expand in scope, or if cross-border payment systems fragment further, the incentive to hold non-counterparty assets increases immediately. Signal 4 is disclosure behavior. When unreported or delayed reserve data becomes more common, it signals that reserve decisions are being treated as strategic, not merely financial. This isn't fear. This is preparation based on historical precedent. Preparation starts with measurement. Know how much of your portfolio's value depends on long-duration cash flows, and how much depends on the purchasing power of the dollar staying stable. Name those exposures, and headlines stop being noise. You do not prepare for a regime shift by guessing the exact month it will be announced. You prepare by understanding that cash is a policy instrument, and long bonds are a confidence instrument. And confidence is the asset that gets repriced when reserves are reassessed. The World Gold Council is not predicting the end of the dollar. It is documenting behavior that becomes rational when the dollar is no longer treated as the only unimpaired collateral. And the market is already voting. In the first month of 2026, the World Gold Council notes gold pushes past $5,000 per ounce for the first time. A tougher decade for cash and long bonds does not mean instant collapse. It means a long grind where the default option underperforms, and the cost is paid in purchasing power. Here is the core thesis. Gold demand at 5,002.3 tons and $555 billion is not a consumer phenomenon. It is a reserve phenomenon. It signals that institutions are re-rating gold as monetary insurance in a world where sanctions, debt, and policy constraints are permanent features. You have a choice. Understand the pattern and position your thinking accordingly, or ignore it and hope this time is different. But remember, this time is never different. The pattern is absolute. If this analysis opened your eyes, subscribe now. In the next video, the same 4-stage framework will be applied to the plumbing of the Treasury market, and why liquidity can vanish exactly when long bonds need it most. The reserve shift is underway. The only question is whether you'll see it before it arrives.